Right. Good evening, guys. This is Raghu. Most of us, we want to know what happens tomorrow, but I'm starting with a step behind. Now we can learn from past analysis. Market is a repetitive of history. So how one could have identified that today market is going to go down. I'm not telling that market has crashed. What I meant is most of the time, other than the initial pullback, market went down due to profit booking. But how one could have identified this scenario? To start with, I would like to take you through the daily time frame candles in Nifty. So if you observe, what do you see in Nifty? So here, 1, 2, 3, 4 candles, almost vertically going up. And this happens usually in an uptrend when market is getting exhausted. We call this as exhaustion phase. Now, however, the catch here is watch the second candle here, first candle and second candle. First one, second one, and yesterday's third one. So if you know Bollinger Band, what do you understand? This is the positive standard deviation, negative standard deviation, and this is the mean. So it is above the standard deviation, and going by the Bollinger Band statistical model, the Bollinger Band, it works in a way where price when crosses the Bollinger Band, it has to close within the Bollinger Band before continuing its direction. So we don't know what will happen tomorrow yet, but this morning in one of our Telegram channel, we had informed the team members that after a gap up, honestly, I did not anticipate there will be 100+ points gap up. In fact, I was of opinion it will be around 50 to 70 points gap up and then it will go down. But I was surprised to see it went 100+ point gap up and immediately it came down, probably to avoid the initial profit booking by the participants. However, what I wanted to tell you here is this candle, the yesterday's daily candle, after a huge gap up, closing outside the Bollinger Band, and previous two candles again closing outside the Bollinger Band, were screaming, telling that market is going to book profit and it's going to come down within the Bollinger Band. That was the key number one. And key two is I would like to walk you through the pivots. So what was the yesterday's trading range? It was kind of a very narrow range. So because of this narrow range, market participants were indecisive and we had a narrow pivot today. Look at this pivot, the blue lines and the red line is the pivot. Compared to yesterday's and give me a minute. Day before yesterday's, we have a narrow pivot. Agree, these are ascending pivots, which indicates trend is up. When you consider the overall market context, you cannot trade any model blindsided. So we had the first idea that market is going to book profit because of the vertical moves and gap up moves. And after every gap up since last 3 days, we did not see any buying enthusiasm from the buyers. In fact, market was kind of going into range. So that was one clue, and the other clue is Bollinger Band statistical model, where prices for last 3 days were closing outside the Bollinger Band, and it was high time that it's going to come within the Bollinger Band. But can we take a trade straight away at the opening? Maybe not. What we could have done here is, since price opened outside pivot R2, we should have just waited for a few minutes to see the price action. There was a sharp down at the opening 5 minutes candle, and these green lines are previous day high. Always previous day high, previous day low is also an important turning point, other than the pivot indicator. These are also can be considered as pivots. Now here we saw a buying pressure, but that buying pressure was not so great. So, and then we had a small inside bar after a big red bar. Whenever you see an inside bar, maybe this is a bullish Harami pattern, you would call. So we were supposed to wait until this inside bar was taken out by another red bar for sellers to demonstrate their strength, because inside bar are always very tricky. It says there's pause in price and there might be a pull back in the opposite direction. So all of a sudden, after a sharp down, we saw a kind of gap up and an inside bar. Price closed here, and this inside bar was supposed to be taken out. So we had one hint here where the inside bar was taken out, and this is where I took my trade. So this was my trade, and just to let you guys know, this is what I made. So this was, I just took around three trades. So overall, and I made 15,000, but we had more than 15,000. My target was, once this cracked, by the time I entered, price was here. So I kept, okay, my stop loss was above R1 because R1 is a resistance. So if there is any momentum, I wanted to target CPR or much below. Near the CPR, I exited. My entry price was 137 and I exited at 160 with 10 lots. Did I trade after this? No, but there was a great trade here as well. This was a piercing pattern. If you see, the close of this was 18,407.65, and see the next candle. The open was 18,405.75. So 0.10 was gap down and then reverse. So this qualifies as a piercing pattern because this has happened at the bottom. So this was a great sign to take a counter trade in the ongoing market. So where would you want to keep stop loss? The stop loss, see, market came down here. This is the previous day low and S1. So the ideal stop loss as per pivot is below S1, because below S1, anytime market is considered as downtrend, this is where the initiative participants as per pivot boss will enter and take the price further down. So this would have been the ideal stop loss if anyone would have entered here. Price went up and look what happens here. This you need to consider as double top as well as a test near the central pivot. See, the upper central pivot or the upper TC, the top circuit and bottom circuit. The top circuit of CPR always belongs to buyers. The bottom circuit always belongs to sellers. Now, if you consider this, there was a good fight between bulls and bears, and bulls won here. So buyers started taking price slowly. I remember I did book some 2K profit here, but it went very slowly upside. And where does it come? It comes and tests R2 here. What is our selling area? This was our selling area. So usually the way I would like to mark selling areas is on a 15 minutes. So I would like to take the high of today, and where exactly the price came, this one. So this would be considered as a selling area, the wick from the next candle. But when the market came back to test, it didn't even test the selling area because there was so much of selling pressure near R2. Please note that R2 pivot is a resistance. So R2 pivot was broken here. It was followed by a big selling pressure. So can we go short here itself? Some people take a risk going short here, but I wouldn't advise that because we are in a bull trend, and after a sharp downfall, market showed considerable strength to come back to where the morning price was. So this shows buying pressure, right? There should be someone who is buying. So we need more price action. So we can consider this as evidence one of weakness. What was our first evidence? Where market went down. So we have the selling area here. So we should anticipate that market should go down again here until unless it breaks the high of the opening candle. Now watch here. We have the second weakness here. After breaking here comes down, again it goes up. This is a kind of yeah, strong bullish candle, but here again we have resistance. Price is not able to close confidently above R2. This was one more evidence where market is showing weakness and it formed a double top, or you can consider a triple top. So any long side should be taken above this as per the triple top. But we do have a selling area, so the ideal long should be above the high of the opening candle. So when should we take short here? Do you see this pattern? Now this pattern, you can consider this as a double top, sorry, double bottom. Now here after the third weakness, market comes down, goes back, and you get a T-bar, and then this T-bar is broken down. Note that this T-bar in any pattern, T-bar is considered that um, buyers are showing strength of buying. Albeit the location of T-bar is incorrect or not conducive for trading, but still this T-bar indicated that buyers are trying to push the price up, but they were not able to show enough strength to close above. But look what happened next. Some buyers tried to take the price above this, but it did not withstand. Hence you see this big wick, and then the candle breaks this double bottom. So one could have gone, taken short here. What would be the stop loss? I would keep R2 as a stop loss. From here, if you would have gone down, maybe after CPR, you could have exited because CPR is the next target after R1 and CPR. But since morning, we had a vertical breakdown from the top, and after market going up, we saw a lot of resistance. One should have just hold it for market to show the resistance, I mean show the exit. What is the exit criteria for me after entering here? If market went down, my next stop loss would be here. This is the previous day high, so I would just keep my stop loss here and just allow market to go down. And you saw what happened. Now, unfortunately, I was not able to trade this entire fall as I was busy with meeting. So this is one of the way where we can trade pivots. R2 resistance, we have a previous evidence selling area, and in the same selling areas, we are facing quite a lot of resistance. Good candidate to go short, stop loss above the selling area. And what would be the target? I mean, target depends upon each trader. He could keep the next pivot as target, or he could keep the CPR as target, or he could just wait. But look at the beauty of the pivots. If I just remove everything, R2, it faces resistance, comes to R1, from R1 to CPR. CPR is considered as the heartbeat of pivots. So people try to buy here, market goes up near R1, see, it faces resistance, a sign. So if anybody who missed this fall, the ideal candidate of next entry point was R1, keeping the stop loss just above R1, and after that, see what happened. Market just went down. So once CPR breaks, where would you keep the stop loss? Above the CPR, the top circuit of the CPR. So in this, maybe if you have entered near R1, your stop loss will be above CPR. And then CS1, then CS2. Market beautifully went down, and then I think it closed a tad below the opening low. Nearest to, we had some buying pressure. Now, what does this mean for tomorrow? This means tomorrow, I would like to just give me a minute, show you how the tomorrow CPR will be. I don't want this, I don't want this, I want only tomorrow CPR. Okay. So we have a very wide CPR, in fact, slightly overlapping downside CPR. Whenever we have such a wide CPR, it means that the trading range has been widened by the market participants. And because of this fall, there might be a lot of confusions between buyers and sellers. So tomorrow, most probably it will be a range bound day. And how you're going to trade, you're going to trade using the pivots. If you're using the pivots, you know any price opening above R1 in a normal day, R1 above, it's a buy, S1 below, it's a sell. Near CPR, no trading zone. Good luck, team.